how much are interest rates going to rise? What will be the impact on the Australian economy? What will be the impact, therefore, on house prices? If you're interested in that, that is exactly what we'll be covering in this video. This is a 3-part series. If you haven't seen the first video or the second video, go check them out before you watch this one. This is part 3, and we'll be continuing on from where we left off. In previous videos, we talked about how consumers have jobs, their incomes are rising, savings rates are really high. We talked about government spending, the different locations of infrastructure projects. We talked about how business saving and business investment capital expenditure is really, really strong. And we talked about so many different angles of the diamond, which is the Australian economy, different facets, different angles of vision to build a total picture. We'll be carrying on. Stick with me. This is really important if you really want to build a multi-million-dollar net wealth for yourself. You need to understand this stuff. Otherwise, you're just having a laugh. You're just kidding yourself. Stick around, guys. Hit the subscribe button. So, base case, how much are interest rates going to rise? The base case is, according to CBA, hike to 1.6% by Q1 2023. Okay, so by the first quarter or at the end of the first quarter, rise to 1.6% and then hold. Okay, so CBA cash rate forecast, this is what it is. 1 month, 4 months, 7 months, 16 months, it's going to go up to 1.6% and hold. And if you don't know the rationale, I won't repeat it. We discussed it in the first 2 videos. Go back and check them out. The market, as of May, is pricing it at this much, and the market, as of just 2 weeks ago, is pricing it at this much. What that means is that analysts, the money markets, they predict or they try to forecast what the interest rate rises will become or what they will get to. Now, if you're kind of freaking out and thinking, oh, CBA is super conservative and normally, the market is so much higher than CBA, I also want you to understand that if you took this chart and took what the market forecasted versus reality, every rate rise cycle, the market always overshoots it by at least 30%. Okay, so is this what's going to happen? I don't know. You tell me, but this is CBA's view, and I can definitely say that if the neutral interest rate is around 1.5%, or in this case 1.6%, or even up to 1.7, 1.8%, that does not relate, or that does not equate to a 30% property market crash in Australia. That is not going to happen. Yes, Sydney, Melbourne will be hit the hardest, but you can see we're still in context. This is the cash rate. And this is the 10-year Australian government bond, is still remarkably low. We're still so low compared to the last 20, 30 years. So yes, we're coming off a low base, but households have the balance sheets, they have the savings. I've talked about that in the last 2 videos. And also there's a good reason why for the last year or so, the Australian Reserve Bank has forced, or I shouldn't say Reserve Bank actually, APRA has really asked banks to put a cash rate buffer, 2 to 3%, up to 3% actually, on new loans. So all those new loans that were written in the last year or so, they have already anticipated a rise of 3%. And that's not even what's going to occur according to CBA. Okay, official interest rates here. You can see New Zealand came all the way down in yellow, and it's going up the hardest. US came all the way down, it's going up. So everywhere is going up. That's the reality. But one thing I also want to mention is just because the US economy is going to tank, yes, when the US gets a cold, Australia also gets a bit of a sniffle. That's true, but it doesn't mean that when the US economy goes into a crisis or into a recession, that the Australian economy goes into a massive, deep, dark recession. You can see in the GFC how much the US was hit, and we were impacted by not that much. And there was always housing markets, even in the GFC, that didn't actually go down. Okay, so always markets within markets, but the point of this was to say, don't get hung up on what's going on globally. Yes, that's important, but we're also our own country with our own capital markets, with our own banking system, which is very strong, with our own balance sheets that the rest of the world doesn't necessarily have. Very, very important point. And you have to look at the DSR for the obvious place to pause. for the obvious place to pause, the debt serviceability ratio. Okay, how much debt? So household debt service, okay, right now, the cash rate is, just over 0.1% now. They just increased it. And the cash rate at 1.25% would be here. Okay, so that is how much households can easily service right now. And you can see as a percentage of their income, mortgage repayments, the principal interest has been coming down significantly. People have been paying their interest off and they've been paying their principal. So what does that tell me? What that tells me that people are so far ahead in their mortgage repayments that they're very resilient to to interest rate rises. And mortgage repayments as a percentage of household income, the interest is really nothing. It's less than 5% of the household income. So it's very important to draw this distinction between principal and interest. Yes, you have to pay the principal off. That's a set amount over the next 20 or 30 years. But interest repayments have come down and down and down. That's why people are paying their mortgages off. Okay. And also this has come down. So yes, this interest is going to go back up, but they've already paid a lot of it off. That's really the point of this chart. Policy could turn contractionary very quickly once above neutral. Okay, so once the interest rate, if it goes too far up too quickly, the Australian economy could turn into recession territory. That's what this slide is implying. So household debt, okay, stock of debt has definitely been going up. We've established that. Very interestingly, it hasn't really gone up in the last 2 or 3 years, as you can see here, and that's very interesting to me. All right, and interest paid has come down. House mortgage repayments as a percentage of disposable income has also come down. So if you say, okay, right now it's at, it was at 0.1%, the interest rate, official cash rate. If that goes up to 1.25%, let's say by the end of the year, then that's kind of where we were at, just before COVID. That's like normal levels. And even if it goes up to 2.5%, which is beyond what CBA is anticipating and what most commentators are anticipating, that's also just at the same level of mortgage repayments as a percentage of disposable income as what they were in 2006 or 2007. So it's not like we're going into uncharted territory. It's not like we're going into a space or a place where mortgage repayments are so much of an impost on households that the whole market is going to come crashing down. We've been there and done that. Okay, and household debt, you can see Australia, like I said before, hasn't really increased in the last few years. It's kind of been flat. You can see this green line. But yes, on an absolute level, it definitely is higher than most other countries except for Switzerland as a percentage of GDP. So if GDP starts to come down, let's say China doesn't want our iron ore anymore, that would be like a big kind of kick in the guts. We really require as a country to continue to grow for us to sustain our lifestyles. And that requires immigration, which we've demonstrated before because we're basically at full employment, which in turn fuels more house price growth. Very interesting stuff. These are just my thoughts and no one knows anything for surety, but it's very interesting, right? Policy could turn contractionary very quickly once above neutral. So housing lending, you can see for yourself, new home loans with a high LVR had really gone up. Okay, new home loans, debt to income of more than 6% is this much. So even though there is a lot of new home loans, only about half of them have a very high leverage ratio or debt to income ratio, and new home loans with an LVR of more than 90% have really been coming down. So what that tells me is that banks have been very prudent. Okay, banks have been very prudent in giving loans and not allowing households to overstretch themselves too much. That's really interesting. It's very important to understand because that allows you to say, okay, well, is there going to be a big default, big foreclosure, all that sort of stuff or not? Okay, and this is not like 2006, 2007 in the US where banks were just throwing money. It's not like that. Housing loan approvals, so owner occupiers, housing loan approvals. This boom was fueled by owner occupiers, and then investors obviously went up as well. First home buyers also fueled the housing boom, but now they've come off. So really, any boom that starts because of investors can turn into a bubble. This one was led by first home buyers and also owner occupiers, upgraders. Buying their upgraded home or a second home. So you can see what's happening there. And then housing credit annual percentage change and new lending. So housing credit has been kind of flat here, and new lending as a percentage of stock up increasing a little bit. So I'm just going to pause there for this video. This was part 3 of really explaining what's going on in the Australian economy, of explaining what the impact on interest rates will be, how much interest rates will rise, and what will be the impact on Australian house prices. I'll do a part 4, which will be the final part of this super deep dive into the Australian economy. Thank you for being with me. If you haven't watched part 1 or 2, go back and watch them. I know these videos aren't for everyone, but they're super technical, and like I kind of said flippantly before, if you genuinely want to create a 7-figure wealth for yourself, these are the sorts of things you need to get your head around. These are the sorts of things you can't outsource, because even most professionals don't really understand them. Okay, and I'm just kind of bringing it to you to allow you to form your own opinions, so you're not swayed by what family, friends, colleagues are saying. You're actually going to the data. My name's PK. Hit the subscribe button, turn the notification bell on, all that good stuff. I'll see you in a couple of days for part 4.